Pattaya City Expats Club is a non-profit social organisation and our speakers are volunteers. The club as such assumes no responsibility or liability for the professional reputation of or the quality of services provided by the speaker today.
Okay, the first statement here, guys, do not panic, okay? Everybody's scared of this, don't panic. The first thing about this is, I'm not gonna say this was a suggestion, but that's as close to the word as I could probably come up with in this particular article, okay? This is what the Thai Revenue Department is planning to go to and amend the law. Now, when it comes to tax law, specifically, you can have a concept that looks like a nice big piece of steak, and it goes through the sausage grinder of legislation, and you end up with sausage on the back end. Then combine that with rule writing on all of this, how it fits into current tax codes, and this can get very confusing very fast. You guys are going to have a lot of questions over specifics over how this may affect you, and here's the answer. There are not a whole lot of specific answers in this. This is a concept of where they're talking about changing the law to worldwide taxation and getting rid of remittance basis of taxation. Now let me go through how this currently is, or how it was, how it is, and how it may be, okay? In the past, and this is prior to January 1st of this year, I've come and discussed this if you guys were here, you could bring in money from overseas as long as it had been in a savings account for more than 1 year, and you could bring in an unlimited amount of money in from overseas, and it was not taxed in Thailand because it was considered savings, okay? September of last year, they changed that. They said that when any money is remitted into Thailand at any point, you will pay tax on that as income, period, okay? So what that means is that 1 year rule goes away. If you sold stock 4 years ago and you're finally bringing the money in, you're gonna have to pay tax on the income from when you sold that stock 4 years ago. This would be a paperwork nightmare and sort of a flaw because how many people can report the income versus capital? Now they did say that pure capital coming into the country for investment, theoretically a house purchase might qualify for this as well, is not taxed. And there's a whole series of rules that are still in need to be written about the as is tax for right now. Again, 3 things: past, current, and future, okay? Part of what I think this statement was about, though, was a very, very serious reform, because the way they were looking at reforming it with, income being taxed from prior years when it comes into Thailand has a whole lot of fundamental flaws with it. Not the easiest system to do and a paperwork nightmare, okay? What they've done is, in this statement, it was very clear, they are planning on amending the law and moving to worldwide taxation, whether or not the income has been remitted into Thailand. What this means is, prior to this, if you had a rental property in, say, Australia with it, and you were not bringing that money into Thailand as income or cash or any other systems, you didn't have to worry about it. Now, when this passes, you will have to report that as income on your Thai tax return. Now, here's the good news, okay? Countries like Australia, United States, Great Britain, Germany, a lot of the European countries have tax treaties with Thailand, okay? What this means is, if Australia is taxing that income, if Ren were to have a rental property there, don't know if he does, but if he did have a rental property, that tax would apply towards your Thai tax liability. Now, especially for you guys from Europe, the tax liability is generally higher in Europe than it is here in Thailand. What this means is you can bring money in, even if you don't bring it in, you'll have to file a tax return reporting your worldwide income in Thailand and show the taxes paid in the current year with us. Now, that sounds horrible, but oddly, it gives you a little more stability because you can bring the money in and out at free flow because it's just based upon a calendar year. Now, we've all been very, very lucky to have lived in Thailand with this policy of almost free taxation. This, though, this coming change is the way most countries work. Most countries will tax you on your worldwide income when you hit 183 days. This is standard to this. I lived in New Zealand for 5 years. It's the same situation. What you end up with is a situation of like we as Americans are in that you have to file an Australian tax return for your Australian income. You have to file a Thai tax return, and you'll have to get these two systems to mesh together with it. We have a staff that handles tax returns, both U.S. and Thai. We can also handle nationalities for the Thai tax returns as well with it. Most cases, guys, this is not really going to result in a big tax bill. Everybody's like, I'm going to get double taxed. Thailand's not going to do that to you, okay? You're going to be relatively secure from that, but you're going to have a pretty complex tax return. This is not this thing where you're going to walk down to the Thai lady down the street who's doing the restaurant accounting. You're going to have to go to somebody who understands the tax treaties and do this. We've actually, under the old rules, we're building a guide on the different countries that we're going to publish that you guys can read that'll try to give you in a little bit of plain language on what the different tax treaty benefits are. Some of these things will say some types of income aren't taxed in Thailand. Some of them will say this type of income is not taxed in the United States. Other times it'll say the tax is limited to a certain percentage in one country and not the other. Those tax treaties suddenly become very, very important on where all this flows. Like I said, we're working on a publication about this. I'm assuming Arden will want me to come back and speak on this on a regular basis to this. But the key here, the biggest key here is this is legislation, guys. They have not introduced this into Parliament yet. They haven't passed it. They haven't written the rules for it. This is a proposed change of where they want to move. Now, other speculation on this is they're writing a series of current rules for the current law as it's placed now with remittance basis of taxation. They might just scrap that and say we're going to move at some point into the worldwide taxation. They haven't announced that. This is clear as mud at this particular moment with it. But really what this is going to be is if you stay here, it's going to be a much heavier load of documentation for you. You'll have to go in and be able to justify the income you receive overseas, report it, show the tax that's either paid or the liability that will be on that income, and then report that on your Thai tax return. That in most cases will zero out your Thai tax return, but there's always a little bit of conflicts. For instance, rental property in the United States, you can depreciate it. Negative gearing is the Australia term with this. And you can make money in cash flow in the United States on a rental property, but owe no tax with that. Is Thailand going to allow the same type of rules if it's not taxed over there? Is it going to be taxed over here? They've hinted that if the income is tax-free in one country with a tax treaty, they won't tax it here, but those rules are not firm yet. Now, here's the big question everybody's asking. Does everybody want to know how to get out of this tax if possible? Okay. First one, less than 183 days. In a calendar year in Thailand, you are not subject to resident taxation. Although this has a direct conflict with Australia because you have to be tax resident in another country if you are to be free of tax residency in Australia. Interesting conflict there with it. So you can move around. Now, you don't have to go back to whichever country you're from. In fact, if you're specifically from the United States, you don't have to go back there. You can spend 3 months in Bali. You can spend 3 months in Vietnam. You can be relatively clear of that just in that calendar year. It's not a rolling 12-month period. This is all based on calendar years. Spend 183 days, less than 183 days in country. You probably don't even have to file a Thai tax return at that particular point with it. Okay. Secondarily, should you choose that this is your life home and you don't want to do that, you can begin to do what we term daisy chaining tax treaties, okay? Currently, Hong Kong has the best tax treaty in that a retirement pension in Hong Kong is not taxable in Thailand for distributions in current income. And Hong Kong does not tax those pensions either with it, because you are not resident in Hong Kong. You can move your assets into being owned by a Hong Kong pension, and you have an unlimited amount of money you can put into this, and it will allow you to be free of Thai taxation. You'll have to file a Thai tax return saying, hey, all my income or this portion of my income flows through from there, and you can theoretically use that and bring an unlimited amount of money. We've got Lee Stevens and Ken Brown. Stand up for a moment, guys. These guys work for Business Class Asia. I think everybody knows them. We hang around a lot. These are the guys who can set up the system for you that allows you to be free of tax on this. And it's very solid. The Thais have already said that they are going to abide by all terms of tax treaties. This is the way out. It will make your life a little more complex as you're doing it to set it up, but it allows you to still stay free of taxation if you want to. It's higher level tax planning, but it was not heavily needed here in the past. It's going to be now. So if this is your lifetime home and you're not planning on going back to the UK or Australia or in America or anywhere else at that particular moment, you can use this and live the free lifestyle year-round without having a tax issue, to this. So there are ways of planning this. And a lot of the times it's like shuffling cards. You can look at other jurisdictions. We can look at the individual tax treaty where you're from and where your assets are and say, hey, this will be your tax rate here. This will be your tax rate there, and do a particular survey for you as well. So if you want to do a full consultation, we can sit there and run down through what this would cost you as an individual and where you would pay tax and not tax with this. It's complex stuff, but this is what is done in most countries. So we do this for everybody else because Thailand is one of the few countries that's been this generous, but they're having to pull us away. Now, I'm going to state this again, and I state this in every conversation I have about these when I do this. Thailand is not trying to target you guys. This is not them going after retirees and expats and forangs who are living here to this. They understand you have a value to this. But the wealthy families in Thailand have had billions and billions of dollars in Thai baht overseas that they've been getting back in the country free of income tax. This is meant to be a worldwide reform of their tax system that had holes in it that you could drive ships through with it. This is meant to fix a lot of those things. We are, as expats, the bycatch here. But you can plan your way to do this, and you don't have to go, I have to get out of town, I can only do 183 days this year. None of those rules are true at this particular moment. You don't have to get out of town for 183 days. We will keep you informed on what happens as this moves forward with it, because this is literally just an announcement of legislation. This may not pass, it may not come to fruition. If you are at all concerned about this in a real way, you need to talk to Lee and Ken about setting up a pension and moving your assets in a way that is smart for you to be here for a period of time. Now, if they start moving this through Parliament, I would recommend you set up those kinds of pensions before that occurs, because what happens is if you're taking money out of one type of pension and it may not be taxable in that country for the distribution because you're rolling it over into a foreign pension, you will get hammered on Thai tax on that pension distribution if the law is passed in effect, because that will be income in that calendar year. If you move into a pension before that comes into effect, you can move into a Hong Kong pension before that comes into effect, it's still outside of Thai's jurisdiction on the initial transfer. In the US would use the term rollover. So if you roll over from one pension into a foreign pension, before this law comes into effect, there's definitely no tax in Thailand on that situation, and you will be free and clear if this comes into effect. So this is going to kind of speed your tax planning up in a real way on this and start looking at those options really, really heavily. I'm here for life, with it, happily married to a Thai wife for 8 years now. With it, so this is shifting my tax planning as well. Just my business is run oddly through a Hong Kong corporation internationally, and a lot of that's going to get moved into a Hong Kong pension, just because of my own situation. So I'm going to be using the same situation that I'm recommending for you guys with it. Okay, I'm always dropping this thing down. Everybody been able to hear me okay? Okay. And so, I'll answer some specific questions about this that you guys have, but unfortunately, guys, the law's not in place, the regulations aren't in place, the rules aren't in place, the forms aren't in place. There's a whole lot of speculation of what can and cannot be done. The only thing we can do here is over the next couple months, and what I'll do is I'll pick like 3 countries. Ren, if you can suggest 3 countries to me by email on what you guys have from nationalities, we'll try to go through the tax treaty and do a presentation about every 90 days of the different tax treaties for different countries so that you guys are able to look at your jurisdiction and go, hey, I'm free, clear on this, I'm on that with it. So we'll try to do that on a rolling basis for you. And now you guys are going to grill me. Should I feel like I'm in a spotlight in a prison cell?
For the more complex tax planning strategies you were talking about, I know it's going to vary by country, but are there some rough and ready rules, like if your income is below a certain level a year, or your assets are below a certain level a year, the administrative is going to eat you up and don't think about it. You should only be thinking about it over certain thresholds. Can you ballpark that?
Not at this particular point with it. There's always a threshold of minimal tax with it. From a Thai standpoint, that's actually pretty low with it. In America, you have $12,500 of a standard deduction. So obviously, if your income is below that, you wouldn't be doing this. But Thai, I think it starts at about $5,000. But honestly, we haven't even gotten close to being able to do that yet. I didn't even have time to put the PowerPoint up to show the tax tree on this thing because this all dropped Wednesday with it. Yeah, they'll talk to you about the specific cost on that thing and cost benefit analysis on this. That's actually where they'd be able to help you out with it. How much this cost when you're talking 25 or 30,000 a year would be a rough ballpark of where this becomes lucrative, but more than likely if it's not even just the amount you're living off of now, it's your entirety of your global income. So regardless of what you're living over here, if you're building up income overseas, this may be a way to move the money in more efficiently. It changes the whole math on them getting more lucrative. If this was just, I'm bringing in $30,000 a year into Thailand, that's not an issue with it. It would not be cost effective to use a trust, pension trust. But however, if you've got rental properties and mutual funds and stocks and bonds, and you're building up, most of this wealth is going to be left to your kids anyway, these are the guys you want to talk to. One of the big other benefits of this is, and Ken and I do presentations on a regular basis. How many guys have Thai wife here for this? Okay. One of the things about Thai wives, and God loves them, I'm very lucky to have a Thai wife. A lot of times, they're not the most sophisticated people in the world. They didn't come from a highly educated background. Their family is not wealthy, to this. And what happens is if you pass away, you pass the money to them, they get a lump sum of money, and the family will immediately start coming at them and pulling the money out and pulling the money out and saying, hey, we'll pay you back. Guess what? These women never get paid back. One of the things you can do with a pension trust too, one of the biggest secondary benefits of it is you can give, because there's no trust law in Thailand, but there is with this pension trust. You can sit there to your Thai spouse and say, here, you're going to get $30,000 or $50,000 from day one when I pass away. The rest of the money will come to you as a lifetime supply of income to you. So you can very specifically, plan from beyond the grave to benefit your spouse, your adult kids, and your adult children. I mean, if you got grandkids who are 18 and you give them $50,000, it's going to a car within 30 days to this. But you could sit there and say, hey, even back in England and the U.S., out of these Hong Kong pensions, that money comes to them for life instead of them getting a new car immediately with it. So, there are other benefits to this other than just a thing to it. But that mathematical formula yet, I haven't been able to work out with it on the worldwide income situation.
A quick one. I heard/read that Thailand is not going to tax profits from crypto trading or crypto. Have
not heard anything about that. I'd hike actually highly doubt that, because this is exactly what this is trying to do, is go after those international income sources.
Okay.
Hi. A friend of mine thinks he's found a loophole via inheritance of an estate. His mother died about a year and a half ago. He has a share of the estate paid into his UK bank account about a year ago. And he's checked through this, and apparently inherited assets from a deceased estate in Thailand are only subject to taxation with amounts over 100 million baht. And this guy's mother wasn't, the Duchess of Westminster. Yeah. We're talking about the proceeds of a small bungalow in Yorkshire. So his inheritance was 90,000 baht. His plan, he's only bringing in a small amount of that in monthly installments, as much as he needs to cover the immigration extension of his visa, the retirement extension, i.e. the 65,000 baht per month. So he's bringing, in other words, 840,000 each month from January to December of this year, which is way under, that's obviously way under the threshold. Now, he's taken some advice and been told by a tax expert in Thailand that he doesn't even need to file a tax return because it's not assessable income, because it's an inheritance well below the threshold. And he thinks he doesn't need to file a tax return. Is that correct?
I'm going to give you a firm maybe.
Yeah.
On that, the part of the problem with this is the rules as they've been written recently almost don't exist. Okay, so you can interpret the rules, yes, but the Revenue Department may come down and say no, because prior to the rule change in September, the amount of rules written over international income coming into Thailand is probably about 2 pages. Okay, they didn't really have a lot of rules, regulations, policies, even forms on this stuff in place. Okay, so everyone, and the expert he talked to, is looking at the rules and trying to interpret a set of rules that may not directly address his situation. So I can't say it's not valid. It probably is, but has Thai authorities ruled on this yet? No. They're very, very stingy with giving guidance on any of these kinds of issues. One of the, under current rules, supposedly one of the grand things to do is you as an expat want to bring in 5 million baht to buy a condo. Okay, don't transfer this from the overseas account into your name. Gift that to your wife, your Thai wife or Thai girlfriend, and then she gives it to you to buy the condo with this in your name. The gift exemption on this. And this may be valid, but Thailand hasn't ruled one way or the other in this, in a particular format with it. In all of this, there is so little guidance in this that it's a lot like swimming through mud, with it. So, I would say probably yes, because that's not really income to him. It was a gift and inheritance. He probably falls just under the gift rules with it, to it. But Thai revenue's not telling us yes or no on any of this,
I have 2 questions. First of all, you mentioned the word resident in your talk. Now, most of the people here are on retirement visas, which are non-resident visas. Does that mean anything? The second question is, if we have to pay tax, what would be the tax percentage rate that we would have to pay?
Okay. You've got the joy of different standards and words and how wording on this stuff goes. Okay, Yes, the retirement visa is not a resident visa. However, for tax purposes, residency in Thailand is defined as 183 days in country. So this is part of the joy of standardization. You got one department saying one thing and the other department saying another. Now, in my opinion, Thailand would make themselves a whole lot easier on all this if they were to say, you're under a retirement visa, that's a temporary visa by nature. You are not subject to taxation here in Thailand unless you're remitting more than such and such an amount of money in Thailand. The Thai revenue authorities would behoove themselves to move into that direction because that would keep you guys here. I mean, we're constantly hearing, I'm going to move out of Thailand, I'm going to move out of Thailand if this passes. But if they put this where you had an exemption under a retirement visa or even possibly a marriage visa, it would make a whole lot of sense and solve a lot of their problems on trying to report this. Because I can tell you that the Thai Revenue Department does not have enough staff to handle all of your tax returns. The 200,000 expats who live in this country plus, potentially, they don't have the staff to do that. We had one couple who had Thai nationality, who'd gone to the U.S., but they remitted the money in within the year, so they got a tax credit for the money they earned in the United States. It was 9 months to get the Thai revenue authorities to process that Thai tax return over a $900 foreign tax credit. One client, folks, 9 months, okay? And literally, conversation with the Thai tax authorities over and over again. We don't know how to do this. We don't know how to do this. We don't know how to do this. Multiply that times 200,000 expats plus tax credits all over the world, tax treaties all over the world. They would be very, very smart to say, retirement visa, free of tax with us. But right now, you're subject to tax by the tax rules, 183-day rules. Yeah. It's very close in the U.S., but honestly, I couldn't, off the top of my head, I couldn't give it to you. I'd have to pull that up and it's a graduated tax rate, although you hit the max pretty quickly because tax rates here, income's so low. Well, go ahead.
Hello. You said earlier one of the ways for tax avoidance would be the
By the way, not tax avoidance,
okay,
tax minimization.
Mitigate the tax by living in different places. So if you choose that strategy, let's say 3 countries, Vietnam, Malaysia, and Thailand, does one of those 3 countries need to be your primary one for other reasons? I'm American, so would that impact the 1040 I do with the IRS?
Yeah. From a U.S. standpoint, you do not need to be resident of another country to use the foreign earned income exclusion or foreign tax credits with it. In fact, on retirement income, the foreign income exclusion doesn't work for you at all. Okay. So no, it doesn't really have an effect on you. Although if you are earning income with it, you need to stay out of the country for 30 days. You can only be in the United States for 30 days with it. Period, if you're earning income. Otherwise, it really doesn't have an effect on you. But you can't use the tax treaty here to take your money out of 401ks or IRAs if you don't use residency here. So, especially for Americans, this speeds everything up because we've discussed this in the past. In Article 19 of the United States-Thailand Tax Treaty, pensions are only taxable in the country you're resident in. Okay, that's currently Thailand. Now, you could take the money out, you could shift it into a Schwab account, you could move it wherever you wanted to. Thailand wasn't going to tax it. And guess what? The United States wasn't going to tax it using the tax treaty as well. Really complex reading of it, but it works. Okay? Now, so say I'm sitting on $1.5 million in my 401k, I'm going to be here for the rest of my life. Okay? I was planning on dripping it out using the tax treaty over 5 to 10 or 15 years. Blah, blah, not being taxable here in Thailand. Okay. Now, that has been thrown out the window because those distributions will now be taxable in Thailand even if you don't remit them into Thailand when you do it. So you're free of tax in the U.S., Thailand's suddenly going to tax this income. And this is why the rollover period is so important. If you are in that situation, you've got a substantial IRA or 401k account, you need to move into a Hong Kong pension sooner rather than later. because I do not believe that Thailand will allow the pension to come out of the U.S. free of tax and rolled over into another pension. What will happen is that if you do it, you're going to lose about 25% of your pension. If you roll it out of the U.S. and into this, you're going to get hit for $250,000 of tax. If you do that prior to this law coming into effect, you're free all the way around, and you can live here forever free of tax. Ken,
yes, Tom.
Again, Ken.
Tom here. Excuse me, but I'd appreciate it if you talking would stop while I'm trying to ask this question. It interrupts me. I handle correspondence and stuff for emails from people to the club.
Yeah.
And an individual couldn't be here to ask the question because he's in the U.S., but he did send his question to me. And I think I could have answered it, but I did tell him I would ask you.
Yeah.
Basically, what his wants to know is that if he pays taxes and on his income and everything in the U.S., in his state, does that make him exempt from the 180-day requirement if he stays here? And yes, I could have answered the no, but please answer it so I can tell him.
Yeah, the part of the tax treaty says at the very beginning of this, for purposes of the tax treaty, residency is defined, can be defined by the laws of the state you're in, which means that even using the tax treaty, it defaults to Thai law to determine whether or not you're resident in that country and thus subject to the articles of the tax treaty. So if he spends more than 183 days here by Thai law, he's subject to taxation here and thus subject to terms of the tax treaty with it. So yes, he's still subject to tax here.
Sorry, I just wanted to check the Hong Kong scheme that you're suggesting. Are you exposed to currency risk there?
You can have pretty much almost any type of investment into it, and you can dollar denominate your investments.
And euros.
Yeah.
Thank you.
Yeah. So yeah, you can euros, UK pounds, pretty much anything you want to. In fact, most of the assets are actually held in the UK through different things. It's just the Hong Kong is a contractual wrapper around it. You can go into Charles Schwab and pick investments in it. You can do pretty much anything you want to in these. These two guys are the guys to talk to after that. They're going to give you more of that. By the way, we're separate companies. With it, they work for Business Class Asia, but we work really heavily because we've been doing this stuff for Americans for years. It's just everybody else is suddenly going to have to pay attention to this in a big way.
Yes, it seems to me that Thailand is trying to tax us based on residency, and the U.S. is trying to tax us on citizenship. So is there a priority? You pay first on residency instead of citizenship?
Yes, no, and maybe. Okay. You've got one of the most joyous tax issues of being an American there's possibly be. As an American, we are taxed as a citizenship wherever we go in the world, however long we are, until we either pass away or renounce our U.S. citizenship. In order to renounce, you have to go to the embassy, U.S. Embassy, state you are not renouncing for tax purposes, but you are current on your tax returns, and you filed at least the last 5 years of your tax returns. Okay? Now, this is where the tax treaties come into very specific effect around the globe for Americans. That will spell out who can tax what in particular instances. In most cases, though, where the income is earned has first right of taxation, and then it flows like water to the country you're resident in. So if the money is earned in Thailand, Thailand will have first right of taxation, and then the United States would have secondary rights of taxation to it, but they would have to give a tax credit for the taxes paid in Thailand to the tax return on the U.S. side of this. So the convention, it's the Convention Against Double Taxation is what the tax treaty is for with it. That becomes very specific. Although you do have written the U.S. tax law as well, you do have the foreign tax credit and foreign exclusion codified into U.S. law that can be utilized even if there isn't a tax treaty, except in places of where there are diplomatic restrictions against. You can't go to Cuba and get a tax credit. You can't go to Myanmar. So if there's a diplomatic restriction against the country, but otherwise those are actually codified in the U.S. law as well.
All right. Well, I'm a citizen of the United States. All my income is earned in the United States. So does that mean United States has first priority, and that if I file my U.S. tax return, I won't owe anything to Thailand because it's already been taxed?
Yes, no, and maybe. Okay, because the tax treaty, going back to Article 19, states that only the country that you are resident in has rights to tax your pensions. Not government pensions, but any type of private pensions. So your IRAs, 401ks are actually not taxable in the United States by the tax treaty, but they are taxable here. So the tax treaty will specifically lay out particular things. I believe that dividends are limited to a 10 or 15% tax here in Thailand with it after they're earned in the United States as well. And this is going to be one of the joys about individual tax treaties for everybody. You're going to start to see that in individual things like bank interest may be taxed at one rate in one country, but not the other with it. So they start getting real complex when you're doing multiple tax treaties. But in general, yes, the U.S. has first rights of taxation, but the tax treaty will specifically state different parts of this and do different tax rates and reorder those things out of what is the normal system to it.
Years ago, I have read from the OECD. OECD is ruling all the tax rules, how countries has to behave with the tax. And I have read maybe 10 years ago that the OECD is planning that all people get taxed by the citizenship, like the American do. How about this?
My bet on this is that this particular reform to worldwide taxation is being driven by Thailand wanting to join the OECD. Okay. Now, there's especially a series of corporate reforms that are moving around of sort of a minimum taxation to be a member of the OECD. That's mostly on the corporate standpoint of 20%. Now, and this shifts back and forth. So 10 years ago, that might have been the trend of moving towards the US side on this. Mostly, though, it's moving more towards residency on where you live with it, but it's moved into much, much heavier reporting. The U.S., for U.S. citizens, everybody, how many Americans have heard of FATCA? The Foreign Account Tax Compliant Act that makes governments report their income, any account holding to anybody who's resident. So if I go to a Thai bank here, FATCA forces the Thai bank to report that information back to the United States. Okay? Son of FATCA was called Common Reporting Standard, which went along through the OECD. And the OECD now says, excuse me, I'm assuming you're German with the language, couldn't quite tell. But so if you are resident here and you open an account, but you have a German passport, Germany will get the notification that you have that account here under Common Reporting Standard. So that era of bank secrecy is gone. So it's moving, right now it's more reporting back to the homeland to make sure that the money's not being hidden with it, but it's still generally based upon first right of taxation is where the money is earned, and then second right of taxation is in the other countries. But this is going to vary by individual tax treaties heavily with it, which, I mean, we've hired a girl who got a master's degree from Queen's Mary Law School in London, and she's specifically sitting there day by day building this by a chart on what each of these says by country. And if anybody wants really, really, really fun reading, go start reading tax treaties. Let's put it this way, it makes golf look like high-speed auto racing to it.
I just wanted to add to what Thomas was saying. Basically, again, a lot of you don't know, I was recruited actually to come and work with Thomas for Americans as we face paying international taxes wherever we live. And if you don't know Thomas's background, for the most part, in America, he was the international guy for a company called Jackson Hewitt, which was a big thing, but he went further to get a master's in international tax and finance. So a lot of this stuff is very important because this kind of education that he has pertains directly to the tax treaties that's going to affect all of us and how they're interpreted. And actually, Thomas and I have been doing this for 5 years. You guys who are not American have the, you can open accounts everywhere, but for the most part, because of these reporting requirements, I don't know if you notice now, if you open an account in Thailand, you have to sign a W-9 form from the United States saying I am American or I'm not American. So because of this additional requirements, a lot of, a lot of financial institutions don't want to deal with us. So we do have solutions that are through Hong Kong. The assets are not held in Hong Kong for the people that are concerned about that. So there are solutions that will help, just like Thomas talked about. Lee and I can handle that. Thomas's office, our main office is in Bangkok. And Thomas has a lot of tax adjusters, not only doing United States taxes, but we also do Thai taxes as well. So any kind of questions you may have, we probably can get them addressed for you, and invite you to come to that office. We do have an office opening on Pratumnak 6. We did make the mistake of telling people that our office was on Soy 6, but we were after a couple people came there, they said, "What the hell?" But Pratumnak Hill 6.
The view was very good.
So we got that cleared up right away. But you've seen how they've been, going after people with the wrong regulations. We all have our work permits and things like that, but we're just doing the final stuff to make sure the office is 100% legit before we're in there every day. But it will be the top part of Pratumnak Hill 6 going down, and Lee lives in Pattaya here now. He moved down here. He's here every day, and we come down here once or twice or 3 times a week to address those issues.
We are right across from the sauna bar, so hey.
But yeah, these are, like Thomas said, there are solutions in place, and there are things that we already do. These aren't new things that are out. These things that we already have in place and have assets with other expats here that want to make sure everything is right for you as well as your spouse, girlfriend, or whoever else, wherever you want to do with your assets.
Planning's really key on this, guys. It's possible to minimize your tax, make your life less complex, although I can't guarantee that the move will be the most fun thing in the world. But, and again, don't panic. But if you are planning on being here for the long term, it behooves you to talk to these 2 guys to move yourself in the safe. Because they, from what I've seen, they've not formally introduced this into Parliament, but you want to do this beforehand and talk to these guys, because you're not going to want to rush this process. These things, moving money internationally takes time. So you're head to get on a appointment with these guys now and see how they can help you in this situation.
Can I just talk to the Brits in the room, because we've done a lot of American stuff? Election in the UK at the moment. Don't know who's going to win. There's a lot of pressure on the Tories to cancel inheritance tax and move away from it completely, which they're resisting completely. The Labour Party is basically saying they're going to increase inheritance tax on wealth, bring more people into it, probably increase the rates. At the same time, at the last budget, they changed the domicile rules in the UK, and they got rid of non-domiciles from April next year. Now, what they're not saying is that that's actually changed the rules for everyone, not just foreign wives. They're trying to remove domicility altogether and move it onto a more of a residence basis. Right? So if you're resident in the UK, you will pay inheritance tax. If you're non-resident in the UK, then you probably won't. But what they've done at the same time is currently, if you live overseas for 6 years, you're kind of seen as being non-domiciled. Not 100%, but you're kind of seen that way. They've actually increased that to 15 years now. Now, whether it's going to apply retrospectively, so if you've already been here 20 years, you're okay, or whether, you've been here for 5 years and then suddenly you've got to do 15 instead of 6, we don't know. But chances are the tax is going to stay, and it's going to go up if the Labour Party get in. Now, Thomas mentioned the Soteria trusts out of Hong Kong. They don't only help with Thai tax. What they do is take your money out of your estate, okay? So you do not pay inheritance tax on it immediately when it goes in, regardless of the rules, Okay, so technically it's not in your estate anymore. If you look at it like a British Airways pension scheme, for example, it's not, but look at it in that way. The money is technically yours, right? But it's owned by British Airways, and they look after it for you. The scheme in Hong Kong is pretty similar to that. A trustee looks after your money, you're the beneficial owner. So if you pass away, the owner of the money in effect hasn't, because it's the trust, and the trust is continuing. So Thomas has got it 100% right. Do it before they change the rules, because all the rules tend to not go back retrospectively and change something that's already in place. All right, so if you've got a trust in place, they change the rules, they change the inheritance tax system, they put the tax up, you're already prevented from paying it. In addition, it removes money from creditors, and it takes it out of your estate, so you don't need to go through probate to pass it on to beneficiaries. So even if you've got a will, 3 to 6 months probably to distribute an estate. My mother died recently. It's taken 5 months so far to get probate in the UK, and we're still not close. All right, and we can't do anything until you get probate. If it's in the trust, it immediately can be distributed. And you can also govern what happens to your money after you're dead. So you can say, for example, my Thai wife gets an income from it. When she passes, my children from a previous marriage get the capital. So you're looking after all aspects of your family with the trust, and the lawyers, the trustees in charge of it will follow your instructions regardless, right? So you actually control your money after you've passed. So that's all I wanted to say.
Speed your planning up pretty fast on this, guys, with it.
You mentioned that the Americans innovation, that inside of the fundamental tax laws.
Yeah. As an American too, you're essentially you can daisy chain tax treaties. You can daisy chain the U.S. tax treaty of no pension distributions, and the Hong Kong pension for here. So the U.S. citizens get a double whammy on this, in that you get unlimited tax deferral, unlimited growth, unlimited income coming out of this, free of U.S. tax and Thai tax. Very, very vital way to do this. But you need to do that now, because you may not be able to roll over from the U.S. pension into the Hong Kong pension, and that be a free tax event. Right now, until this rule is passed, that's a tax-free event.
So let's take a hypothetical. At some stage, we're going to have to file a tax return here in Thailand. Let's take an individual who has a relatively simple situation. They have a pension from their home country, and they have some savings which they're earning some money in their home country. How much roughly would your company charge to file a tax return on their behalf?
You have my biggest business stress in history to this. Right now, my firm is 26 people. It makes us the largest international tax firm, as far as I know, actually in Southeast Asia. I am looking at having to add, when these returns come into effect, anywhere from 10 to 25 qualified Thai tax accountants. We don't have the proper forms yet. We don't have the proper rules yet. We don't even have a confirmation that this is really going to start needing to be filed for next year. What I am doing now is putting a large amount of infrastructure in place prior to hiring these people, because I don't want to hire them next year and they say, yeah, this is going to be pushed back another year with this to it. So literally, my computer infrastructure is going through the roof right now to be able to handle this. And I apologize to Bill in US dollars with this. My assumption is probably $300 to $400 US, but I honestly don't know. Again, there's so much speculation on that. That, I mean, like I said, I've got computer equipment coming in, I've got desk, I've got new office space. Whether I go from 140 meters I'm currently in to 280 meters, or do I go ahead and triple that space instead? All of these are my biggest business challenges. We're going to try to make this as reasonable as possible for everybody, but I can't quite give you a firm number on that. My ideal is $300 to $400. Obviously, the complexity price goes up, but for a simple one, hopefully that's what we're trying for. And just so you know how complex this gets, talk about UK. My master's thesis is actually based on the UK remittance basis tax charge for when you're not residents there. So my master's thesis title was, does the UK remittance basis tax charge qualify for the US foreign tax credit? I spent 6 months trying to get it that short.
Hello, can you hear me?
Yes.
Okay. People with cryptocurrency that have got things like DeFi contracts that earn a small amount every day, where's that going to be taxed, and how is it going to be taxed?
Theoretically, from the motions I've seen, that's one of the biggest reasons that Thailand's coming in to try to tax us. If it's not taxed in any particular country, you have to report that on your Thai tax return, and you'd pay tax on it. Whatever, if it's straight interest, you'd pay the interest rates. If it's capital gains, so part of the reason they're doing this is to bring all of that into the Thai fold.
One last one over here has been waiting a long time.
Sorry, I'm right-handed, so I tend to concentrate on this side.
Last one.
If you put the money in the Hong Kong trusts, are there limitations as far as bringing the money into Thailand before they start getting upset about it?
As far as I know, it would be a free flow of money. There are restrictions on a pension of like it has to be there for 12 months, although you can loan from it. There was the flow and everything. That's actually talk to Lee and Ken specifically about. They can give you far more details with it. Because you're going to have certain restrictions. Any type of pension is going to be a certain minimum age to withdraw. I don't think that's a big problem in this room with it, but but yeah, you're going to have certain restrictions inside the pension, mostly from the Hong Kong standpoint. But once that money goes, it can flow with it. And by the way, guys, I'm now officially going to tell Ren I don't need another certificate. I've done my wall is getting full.
I'm sorry, I've already registered the value of this with the Thai tax department, so you're going to have to pay tax on it. I'm sorry. Okay, this is your. But
by the way, guys, Ren got back to me in like 5 minutes on this. If you don't think Ren is looking out for you on these kind of things, you should give this guy applause, because he immediately got back to me and said, yes, please come speak.
Next time I'm booking you over 2 weekends, so 2 weeks. You got to take it off me. It's getting heavy.
Yes. Thanks. Thank you.
Huge round of applause for Thomas. We are really, really, truly lucky to have great relationships with Thomas and Ken and Lee.